Over the next decade, the US debt will reach $50 trillion. Interest on that debt will cost over $1 trillion. Meanwhile, the US generates roughly $4 trillion in revenue a year, which means that 25% of revenue will go to interest. There are more government debts in America than in China, Japan, Germany, and the UK combined. How can this possibly end well? Why governments borrow money? A government borrows money if and only if it is spending more money than it is taking in revenues, and where the revenues are mainly coming for taxes. Politicians find themselves in an awkward situation. They need to provide citizens with the services they demand, but cannot tax them too heavily due to fear of losing votes. Consequently, governments opt to borrow from the financial markets by issuing bonds and thus provide lenders with interest for their loans. This is a popular choice for politicians as it keeps voters happy without totally relying on taxes for revenue. Having debt is not necessarily a bad thing. It's how governments spend the money they borrow that tells us a lot about them. Several economies have been plagued by excessive debt in recent years. Governments say they will reduce it over time, so there is no problem. But the politics is wrong. Private and public debt stocks have been rising decade after decade, with private debt being debt held by households, credit cards, corporations, and financial institutions, and public debt being central and local government debts. In economics, we use what we call the total debt to GDP ratio. For example, if a country economy through its productive capacity can generate $2 trillion a year and has a total debt of $1 trillion, then the debt ratio of that country will be 50%. A look at the global economy shows that in the 70s, debt was about 100% of GDP. By 1999, it was 200%, and last year it reached 350% of GDP. The current debt level is more than 3 times higher than the amount of productive capacity on the planet. In advanced economics, we can see serious levels of debt related to GDP and rising. In the case of the United States, the figure is close to 130%, more than double that of 2007 before the financial crisis. So, we have a mountain of debt, and many institutions, some parts of the household sector, some parts of the business sector, some financial institutions, some governments, some entire countries are insolvent. In some cases, given their income, they're not going to be able to pay back their debts. So I call them zombie institutions. The end of a free party. Until recently, even those who had debt ratio that led to insolvency could survive because we had very low interest rates. We were low because we had zero policy rates, negative policy rates, quantitative easing, and credit easing caused by pandemic. So, debt was high, but the interest you paid on it was very low. Money was free. This situation is over. Unfortunately today, inflation is still very high in the UK and in most European cities. Central banks must face this by increasing interest rates, causing mortgage rates, credit card interest rates, auto loans, student loans, and business loans to rise as well. These institutions that were already struggling with refinancing debt are now facing increasingly high debt servicing payments in a contracting economy. We've entered into a recessionary period accompanied by inflation. Print money is not a solution. There are some people who think the governments can just print money and cancel their debts as an easy solution. But this is not true. In addition to being ineffective, this measure would also be devastating to the economy. If a country decides to increase the money supply, the amount of money in circulation, above what is considered a normal replacement rate, such as renewing deteriorated banknotes, it would lead to an increase in general prices and inflation. And I think we have enough of that today. The last indicators. The latest numbers on inflation coming from the US and Europe and other advanced economies show that inflation now is quite sticky, but we continue to have several negative aggregate supply shocks affecting price and wage inflation. The central banks have a dilemma because they need to raise rates more to combat inflation. But if they do, the economy will begin to contract quite soon. As long as inflation doesn't get back to 2%, I expect a recession in the US, Europe, and other advanced economies. That's a definition of a stagflation, recession, and inflation well above target, a period of slow economic growth and joblessness combined with high inflation. Inflationary expectations seem to be on the rise. The Federal Reserve in recent days has hinted that interest rates will have to rise more than expected, close to 6%, to bring current inflation down to the target of 2%. But we have a problem there. I think that the Fed already will have to be certainly above that 6% to achieve their inflation target, but on the other hand, if you raise interest rates to 6%, then you're going to have a real hard landing. We could see a drastic downturn in financial markets, equity markets suffering a major correction, and an increase in borrowing costs for companies. So I do believe that actually, given the rise of debts private and public, we are in what economists call a debt trap. Another critical point that will affect citizens directly will be mortgages. The increase in mortgage debts will continue to rise, preventing families with fewer resources from paying their monthly payments and forcing families to cut their expenses in other areas of the economy, affecting the sales of companies, which will also see their debts become more expensive. It is a virtuous circle of death. The first warning. With the collapse of Silicon Valley Bank, the 16th largest bank in the United States, characterized by financing technology companies and startups, we have already seen the first direct consequences of these interest rate hikes. This is the biggest bank failure since the 2008 financial crisis. As any traditional bank would, the bank bought billions of dollars in bonds over the past 2 years with deposits from customers, motivated by large credit facilities of the past years. However, now due to interest rate hikes, the value and price of those bonds have drastically fallen. Because the macroeconomic situation, venture capital funding has dried up in recent months, and Silicon Valley customers have begun withdrawing their deposits, which led to the bank selling its own assets to be able to respond to all the withdrawings. That required selling those bonds at a significant loss, and those losses added up to the point where Silicon Valley Bank became effectively insolvent. Despite the Federal Reserve's decision to intervene in the bank and its announcement that it will bail out the bank's customers, there are fears that a contagion effect on other banks, leading to a new financial crisis as in 2008. What's next? That financial distress is going to make the recession more and more severe and will increase defaults by household businesses, corporations, and more financial institutions like Silicon Valley Bank and some governments in poor countries with serious debt problems. Some people ask me how likely we are to enter a US-led global recession, and I would say it's certainly more than 50% of probabilities. US and Europe are going to have an outright economic contraction. Some other countries like India are going to do okay. China is going to have some pickup of growth because they are eliminating their zero-COVID policy. So there'll be a recession in most advanced economies. My forecast for equity markets and stocks this year is that they will continue to go down. After years of monetary and credit easing policies and excessive indebtedness, stagflationary pressures are now putting the squeeze on a massive mountain of public and private sector debt. The mother of all economic crises looms, and there will be little that policymakers can do about it. Don't forget to hit the like button and to subscribe and activate all the notifications of this channel. See you in the next video. Greetings and good investments.